Most of us spend our lives in a state of constant motion, working, earning, and paying, yet somehow unable to stop. Along the way, we collect the standard markers of a modern life: student loans for the degree, a car note for the commute, a mortgage for the home, and credit cards for everything else. We're taught to view these balances as temporary hurdles, debts to be cleared so we can finally start our real lives. Yet most people spend decades in this loop, feeling a sense of personal failure when the debt-free milestone remains out of reach. The finish line keeps moving further away the closer you get. It's as if the track was designed to keep the runner in place. To a bank, that balance is a highly engineered, deeply profitable consumer product. When you borrow money, you are essentially paying a recurring subscription fee for the privilege of using that cash. We call that fee interest. Take a $5,000 credit card balance at 20% interest.
This chart shows the widening gap between the money you spent and the cost of keeping that balance open. The minimum payment acts as a user retention strategy. It is designed to keep the account active while barely touching the principal, allowing the interest curve to grow. By paying only the minimum, you stretch the repayment over decades, multiplying the cost of the original purchase several times over. Late fees and penalty charges further increase the profit margin, ensuring the product remains lucrative even when the borrower struggles. The goal of this business model is to maximize the duration of the debt, extracting steady payments for as long as possible. This strategy isn't limited to individual credit cards. It is the engine that drives the global macroeconomy. When central banks lower interest rates, they make this debt product cheaper to buy. This encourages households and businesses to scale their borrowing, increasing the bank's total customer base. Modern banking works through a process where issuing a loan literally creates new money. If every debt was paid off tomorrow, a massive portion of the global money supply would disappear, causing the entire economic framework to shrink. This continuous borrowing fuels the massive consumer spending that drives corporate growth and pushes stock markets ever higher. The global financial system structurally requires a constant supply of new debt just to remain functional. Beyond the financial mechanics, debt functions as a tool for behavioral modification. Borrowers become intensely risk-averse. They stay in jobs they dislike and avoid financial risks because they are tethered to a schedule of monthly obligations. This creates a compliant workforce that prioritizes steady, predictable income above all else. This heavy, lingering obligation creates a self-imposed cage that entirely dictates how a person lives their daily life. The system markets the debt product aggressively, yet it rarely provides the instructions for how to stop using it. Most consumers use debt to purchase liabilities, depreciating items that drain their wealth every month. Wealthy institutions use that same debt to acquire assets, investments that generate more money than the cost of the interest. One group uses the product to build a cage of obligation, while the other uses it to build a fortune. Understanding that your monthly payment is the bank's most valuable asset is the first step toward changing how you engage with the system. Recognition of the business model is the only way to eventually step off the treadmill.